Good morning, good afternoon, traders. Igor here, MrTopTick.com. Welcome back to the channel. If this is your first time joining us, please consider subscribing to the channel, like this video, and share it with somebody that you think could benefit from this. Today, I want to talk about a trade I had posted a couple of weeks ago for members of Income Navigator. This is a variation to a 1-1-2 trade. One key difference between a 1-1-2 and a bear trap is that instead of selling an out of the money put naked, a bear trap uses an out of the money short put vertical or put credit spread. Let's have a look at the video trade setup for the 14th of October SPX Bear Trap with SPX trading at 39.39. So we're looking at a trade setup here, similar to what Tom King posted earlier today. This is an income trade in October 14th expiration cycle with 38 days to go. The trade setup here is a bear trap that is set up somewhere between 3,700 and about 3,430. The way this trade is set up, I'm buying a 20-point wide put debit spread. So I'm buying to open the 3,700 put. I'm selling to open the 3,680 put. All right, so that's a 20-point wide put debit spread. And I am financing this put by selling a further out of the money 50-point wide put credit spread. I'm selling a 3,450. And I'm buying a 3,400. So this is a 50-point wide put credit spread. Credit that I'm going to collect for selling the put credit spread is going to cover almost all of the debit that is required to buy the 20-point wide put debit spread. So this is what the risk profile of this trade looked like when we took the trade. As you can see, this is a put debit spread, pretty much financed by selling a put credit spread out of the money. If you did have a chance to look at the 1-1-2 trade posted last weekend, you saw that selling out of the money puts naked allows us to go much further out of the money versus selling a put credit spread in order to finance the purchase of a put debit spread. I'm going to step through every step of the way of this trade to show you adjustments that I have made along the way and how I manage this trade from entry to exit. So this is on entry. This is a 20-point wide put debit spread financed by a 50-point wide put credit spread. Initial debit was 75 cents. So my risk is I have a 20-point wide put debit spread and I have a 50-point wide put credit spread. The difference between the widths of these two spreads is 30 points, which puts my risk at $3,000 per one contract, plus the $75 debit that I paid to enter this trade. That puts my max loss in this trade at $3,075. So a 1-1-2 that I did in the SPX using a naked out of the money puts margin requirement for a 10 lot was somewhere close to $200,000. As you can see, using put credit spreads instead of selling options naked cuts buying power requirement drastically. This trade required only $3,075 to put it on. So now we go further. My first adjustment was on September 15th, about 8 days after I took the trade. SPX was trading at 39.09, so we can see that we're down about 30 points from where we began in this trade. My comments were, let's roll the wings down to eliminate upside risk for now. So what I did was I moved my long options, my 3,700 put, I rolled it down, and I also rolled my 3,400 put that I was long. I rolled that up. This was a net credit transaction. I collected 85 cents, which took my upside risk from 75 cents or $75 per one contract to no risk on the upside. So this was my first adjustment to eliminate upside risk. I rolled my long options in closer into the body of this structure. I collected a credit. Obviously, I have shrunk the size of my potential area of profit drastically, which is a negative, but the positive is I eliminated upside risk and I also reduced risk on the downside. So here we are, 8 days in the trade. S&P moved down about 0.25 standard deviations. We're showing about a $70 unrealized profit in this trade. We're still way outside of the bear trap. We can look at the chart real quick and we can see that since entry, market has rallied a little bit. We pulled back. We are below 21 and 8 EMA. We are somewhere around 3,900, and I am looking for a push towards 3,700 down to about 3,600. Now we can go forward a couple of days. The following adjustment did not take place until October 3rd. So this is my adjustment that I made on October 3rd. I wrote S&P was at 3686. We're going to make another adjustment with 11 days until expiration. I'm going to once again roll the wings in, collect the credit, reduce the risk. Same thing as I did in a previous adjustment. So what I did was I rolled my longs down on the upside and I rolled my longs up on the downside. Once again, shrinking the size of my bear trap. I collected a 85-cent credit, which further reduced my downside risk and actually left me with a net credit on the upside, meaning that if S&P was to move outside of my bear trap at expiration, I was going to make a small profit somewhere around $95. And if I was going to capture price inside the trap, my potential here was somewhere around $600. Now you can see my risk went from about $1,450 or so down to about $400. So with this adjustment, I took $1,000 risk off the table, gave myself room for a little more upside as far as reward goes, and we have 11 days until expiration. This is what the trade looked like with 11 days. Next adjustment was on the 12th with 2 days to go. As you can see, this position is sitting at about a 10% unrealized profit. We are in the middle of the bear trap, holding it for the next 2 days. If we are inside 3450 and 3680, we have a potential to make up to $600. However, if we move up or down outside of our profit area, this trade could potentially be a small winner on the upside or a small loser on the downside. So what I did on October 12th with S&P trading at 35.88, I wrote, this trade has 2 days until expiration. We can hold and see if it expires inside the trap, or we can book the trade and look for a new trade setup. So my trade was to exit. I sold to close the entire structure for $2.40. Now you can do math real quick. I collected $2.40, I collected 85 cents, and I collected 85 cents. So net, I collected $4.10 in credits. I had spent 75 cents to put this trade on. So if we take 410 minus 0.75, that puts me at a profit of $3.35 or $335 per one contract. And let's remember, my initial risk in this was $3,075. So if we take $335 divided by $3,075, we have a profit or return on risk about 10.89%. So we can round this off to about 11% return in just 35 days. So that's another way to structure 1-1-2s or bear traps if you do not want to use naked options. If you don't want to take the risk, or if you simply don't have the buying power to do so, you can consider doing this as a bear trap with defined risk, placing a put credit spread on the downside instead of selling out of the money puts naked. I hope you liked this video. I hope you have something to take away from this. If you did enjoy this content, please leave a like, consider subscribing to the channel, share this video with somebody that you know could benefit from this. And we're going to see you in the next one.